Okay, and welcome students who are taking financial accounting. And in this series of videos, we are going to be working on the Chapter 4 exercises, the Group B exercises that were assigned in the digital study guide. As a quick uh, kind of repeat of what I've been saying in almost all of these videos, if you don't understand something, if you're not getting the answer, it's generally not due to the application part of it. It's due to the understanding the concepts and principles in the theory. So go back and watch the theory videos, and not just this chapter. And this will be a decent example of it in that I just kind of like looked ahead, and like the first 5 problems are all about making journal entries. So with journal entries, you know, we have 2 things are crossing my mind. One, you have to be able to understand the concept. Like if you have returns and allowances, credit memo, you have to understand the concept so that you can be able to calculate the right amounts. But you also have to be able to make the right journal entries. So the theory part of making the right journal entries, is not being covered in Chapter 4. It's being covered in chapters 1, 2, and 3. Right. And also there's a section called Introduction to Accounting and Bookkeeping, which covers how to make journal entries. So go back and watch those theory videos, and if you still don't understand something, then feel free to, contact an instructor. It's our job to be able to help you understand, those concepts and theories. But when you're actually doing the problem, application, that's what these videos are for, to be able to watch the application of it to help clarify the application. But if you're still not getting it, it's because you're missing something with theory, and you need to go back and fill in those gaps. And again, if you still don't understand, contact an instructor. With that said, like I said, I just quickly glanced at the first 5 problems, and it's like just all journal entries. Okay, so I'm not going to tell you how long it's going to take for me to be doing these. I'm just going to get started and keep on moving and explain how to do the math mostly. Making the journal entries should already starting to become second nature. Okay, so let's get started here. Get my pen. All right, it says inventory, adjust inventory based on the physical count. Okay, the inventory account for Sullivan Industry had a balance of $157,300 at the end of its fiscal year. So the inventory account, that's on the general ledger. Okay, that's not the physical inventory. A physical count taken at year end revealed that the amount was $154,900. So it says journalize the adjustment for the inventory shrinkage. All right, so if I have 154,900 is what I have on hand, and I should have 100. In my books, I have 157,300. My books say I have 157,300, and my physical inventory says 154,900. Well, the difference between the two is $2,400 of shrinkage. That could be due to theft, breakage, whatever. Okay, and that's why we do the physical inventory. So I have to journalize the adjustment to record inventory shrinkage. All right. So what am I adjusting? And let's go through quickly go through the thought process of how to make a journal entry. I ask myself quickly, 1, am I affecting cash? In this case here, no. So 2, am I affecting accounts receivable or accounts payable? Okay, no. So then 3 is I use the account that makes the most amount of sense. And in this case here, we're talking about inventory. All right. So I have an inventory account, and I know that inventory is an asset. And the normal balance of an asset, normal balance means what increases an asset. Well, I increase assets on the debit side. So whenever I have, an amount here and I gain inventory, I'm going to debit my inventory. Well, in this case here, my inventory is shrinking. I'm decreasing it. So when I decrease it, I have to credit it. So I'll credit my inventory account for $2,400. Okay, if I, all journal entries, debits have to equal credits. So if I credit something, I have to debit something else for $2,400. Well, what am I going to debit, right? Well, what do we do with inventory when it's purchased? Like when we sell our inventory, when you make a sale, and let's just say it's for cash, we end up debiting cash and crediting sales revenue, right? Crediting our revenue account. And that's when we're selling something out of inventory. And whenever we make a sale, we also have to be able, adjust our inventory accordingly. So what do? We take it out of inventory, right? So we end up crediting our inventory, and we end up debiting what? Our cost of goods sold, right? Why? Because we have our revenue less our cost of goods sold gives us a gross profit, from which we take the remaining expenses in order to get our profit or loss. So right there is what we do when we have, when we're taking something out of inventory, right? And, we expense it to cost of goods sold. Well, this is no different. I mean, we're adjusting our inventory for breakage, and it's a part of the cost of the items that we're selling. Okay, so we treat shrinkage as part of our cost of goods sold, and our journal entry ends up debiting cost of goods sold, crediting inventory for that amount. Now the question then says, what could cause the inventory balance? What could cause the inventory balance according to the physical account to be different from the ledger account? Okay, as I had said, it could be things like theft, breakage. It all depends upon the item. Spoilage, like in the case of milk, all right? The answer says it. The main reason is it's lost, stolen, or damaged. Okay. Theft is obviously stolen. Breakage is damage. Spoilage is damage. Lost. Yeah, I don't consider lost that often. You shouldn't lose stuff if it's lost. You're generally going to go and find it. But I mean, it is possible to be lost, and if that's lost, I consider that as also part of like theft. All right. But it doesn't really matter. The point being is that there's a reason why it's missing and it isn't there, because theoretically, in a perfect world, there shouldn't be a discrepancy between your inventory and what you have on your books. Okay, you shouldn't have to account for that difference. Right? Okay, 26. It says here, on November 15th, Levery's department store purchased 4,300 of inventory on account from one of its suppliers. The terms were 315, 3% 15, net 45, FOB shipping point. On November 18th, Levery's department store paid freight charges of $350 related to the delivery of the goods on November 15th. Upon receiving the goods, Levery's department store checked the order and found $300 of unsuitable merchandise, which was returned to the supplier on November 20th. Then on November 28th, Avery's department store paid the invoice. So let's create a timeline here. Okay, so on November 15th, all right, it purchases 4,300 of inventory on account. So on account being accounts payable, right? We're purchase we're purchasing on account, so that's an accounts payable. The terms are 3% net 3% 15, so 15 days from 11/15 gives us 11/30. All right. FOB shipping point. All right. So remember what FOB shipping point is. All right. freight on board shipping is, when does title pass, and it's paid on the destination, right? Okay, on November 18th, so 11/18, Lavery's department store paid the freight charges of $350. Okay, because why? It got to the destination. Remember, we're Lavery and we're buying, so we're buying it from a vendor, and here's Lavery, and here's the vendor, right? So FOB shipping says it's leaving the vendor, right? It's leaving the vendor, but when it hits Lavery's dock, okay, that's when Lavery pays the bill, right? That's they're responsible for paying the bill. So that's the $350 that he's paying to the shipping company, all right? So that's related to $350 related to the delivery of goods purchased on November 15th. Upon receiving the goods, Lavery's department store checked the order and found $300. Okay, so I have $300 for a return, right? No good, and found $300 of unsuitable merchandise, right? It's no good, which was returned to the supplier on November 20th. Okay. And of course, who's paying that? Well, Lavery's paying that because he's returning it. I mean, he paid for it, coming. He's going to pay for it going back to the vendor. All right. So then on November 28th, right, Lavery pays the invoice. So now he pays the invoice in full. So we have to journalize all of the transactions, and we can omit the explanation. So what do we have here? So we have on 11/15, we're going to debit my inventory, right? Because we're buying the $4,300 of merchandise, and we're crediting accounts payable because it's, we're buying it on account, right? Now, on November 18th, we have to pay an additional $350 in cash for the freight. So we're going to credit our cash, right? Am I expecting cash? Yes. It's decreasing, so I credit my cash by the $350, and I have to debit something else. Well, what am I going to debit? Well, when you're buying inventory, all costs involved with that inventory, go against inventory. All right, it's a part of the cost of of that that product. So the freight charges that are associated with the inventory go into the inventory account. Right? It doesn't go to supplies expense. I'm sorry, freight expense or shipping and handling expense. Notice I'm saying shipping and handling expense. Notice I'm saying expense. Well, expense is something in the normal cost of doing business, meaning like things like stamps, or you're mailing a package or something like this. Freight costs when you're buying inventory. When you have inventory and you have freight, so let's just call inventory, say $100 and freight 50. That's the total cost of the inventory, right? Of 150. So even though he's paying 4,300 on the 15th, he has an additional 350, on the 18th. So the total inventory cost in this case here is 4,300 plus 350 gives me 4,650. That's what should be in the inventory account, because that's the freight is associated with that inventory. It's not an expense to that freight is not an expense to the business. It's part of the inventory. Now realize that when you take it out of inventory, right, and then you move it over to cost of goods sold because you sold it, cost of goods sold is an expense account, okay? So that freight, actually ends up as an expense anyway, all right? It's just in a different account. It's what it is associated with, because remember, we take our revenues less our cost of goods sold to find out what our gross profit is on that product, okay? Before we take out our operating expenses, right? We want to know how much money we're making when we sell. I mean, if I make, twice, 200%, 300% on a product, or in the case of like the hospitality industry, when they sell, a dish of food, you go to a restaurant, they're only working on 25% margins for the gross profit, okay? So they want to know what that gross profit is. Then you take out your operating expenses to get your profit or loss, right? So you're just moving that information into a different spot, that's all. All right, so let's see here. So that's 1118, all right? So now we're going to return $300 on 1120. So on 1120, all right, if we're returning $300, that means we don't owe it anymore. Okay, so if we credited accounts payable here, that means we're going to debit accounts payable, right, for 300, right? And we're just reversing this entry, right? So I have a debit to accounts payable and a credit to my inventory account for 300. Right? So that's all. When you're returning it, you look back and you look at the previous transaction, and you just make a reversing entry to that. Right? Okay, but now we're going to have to pay for it. So it's now 11:30, and we're going to have to figure out how much we're going to pay. Well, when we look at our accounts, we had a credit to accounts payable for 4,300, right? And we have a debit to accounts payable for 300. So our accounts payable, we have to adjust that by 4,000. And since that has a credit balance, we're going to debit accounts payable for $4,000. Okay, and since debits have to equal credits, we're going to credit something else. Okay, all right. Well, what are we going to credit? Well, we're going to credit, cash, because we're going to pay our cash. But how much cash are we going to pay? Well, we're not going to pay the full 4,000. And remember, debits have to equal credits. We're this paying on 1128 fell within the discount period of 3% 15. So we have a we're going to have to adjust our inventory by crediting our inventory for that 3%. Well, 3% of if we have $4,000 and we're only going to pay we're taking a 3% discount, we're only going to have to pay 97%. So 97% of 4,000 is $3,880, and the difference, or 3% of 4,000 times 3%, is $120. Okay, so I end up crediting my cash for 3,800, and I credit my inventory for 120. And that's doing the math on that. So in figuring out how much we owe, if you created T accounts, you would have seen that you had an accounts payable here where you had a credit of 4,300, and then when you returned the item, you had 300 of returns. And that means you needed to debit accounts payable for an additional 4,000 in order to make your balance in that account zero, so it washes out. So we end up with here this debit for accounts payable. Now, debits have to equal credit, so we have to credit something else. Well, we're going to pay cash, but we're not paying the full amount. All right, we're taking a 3% discount, so 4,000 means we're paying 97% of it, and that's how we got our 3,880. I could have gone and said, okay, I take, I have a 3% discount, so I take the 3% and I end up with 120, and then I take the 4,000 and subtract 120 and still end up with 3,880. Okay, both ways work. I end up paying the 3,880 here, and I calculated my discount here of $120. But you don't, think about what you're doing. I mean, we've been talked in the last few problems, we've talked about sales discounts and purchase discounts. Okay, we're not dealing with sales, we're not making sales, and we're not purchasing for the operation of the business. Okay, we're talking about buying our inventory. And again, anything that's associated with the purchase of that inventory goes into the inventory account. So if I buy inventory and I have freight and I have discounts and I have returns and allowances and I have tax, right? They all go into that inventory account, all right? Because I'm trying to figure out exactly what the cost of the inventory is. That's, what goes into that inventory account. All right, so I hope you've gotten that, and with that, I'm going to stop here. If you don't understand it, go ahead and watch the video again. I tried to cover some theory here along with the application of it. The application was basically just doing the math, but and figuring out the timeline, doing the math. But I also gave some theory along the way. So if you're not getting it, rewatch the video. And if you still don't understand it, contact an instructor. And I'll see you for the next problem 27 in the next video.